The Pipologist, aka Stiletto Pips here, and I am bringing to you today the analysis that I did for me and my private group of traders this morning during the New York session, and I am going to share with you how we were able to capture over 2,000 pips. You heard me right, 2,000 pips. And then I want to share with you how that equates to you putting money in your pocket. You want some monies, right? Everybody wants some monies. Well, guess what? I'm going to show you how to get to the monies, y'all. So let me show you how to get to the monies, y'all. Very, very simple. Okay. So I want you to look at this chart right here, right? I'm looking at the AUD JPY, and I'm looking at the 1 hour time frame. Just look right here. 1 hour time frame, AUD JPY. Right? The first thing you always ask yourself, trader, is what is the dominant trend of the market? Y'all know I always say this. Same questions. What's the dominant trend of the market? Well, you have a trend zone line and a trend line. At least that's what we use at my school, FNU, Freedom Nation University, right? So we have two, not trend lines, but two moving averages, all right? One is considered the trend zone, one is considered the trend line, right? So whenever price is below this line, it is said that you would be in a bearish market, okay? Now, what you see right now is price is sandwiched between these two moving averages, and so that means that it's trapping. I call it trapping. The market is trapping. However, that is a opportunity for you to take a counter trend trade if it was going upwards. So like right here, even though the market was down, right, it was below this trend zone, but the actual participants in the market was pushing it up. We had some buyers that came in right here at this support level, right down here, and began to push the market up, right? And so this was a counter trend opportunity that we took the opportunity to look for a trade by just dropping down to a lower time frame to see if we can get an entry. And so what happened was, right? So the 15-minute was going up. So we need a entry time frame, a low enough time frame to get us in at the early move, like right around here, right? So I'm going to do this. I'm going to show you again on the 1 hour when it started going up, which would have been this candle right here, right? And then I want to drop down to the 15-minute time frame. Voila, it went into the trap. That means that there was an opportunity to enter this trade on an even lower time frame. So now I'm going to drop down to the what? 1 minute, right? Let's go to the 1 minute. And on the 1 minute, we're going to look for that very same vertical line, and there it is. And see, on the 1 minute, when it crossed and closed above here, here was your entry. Here was our entry right here, okay? At the close of this candle or even the close of this candle, either one of them. I like this candle right here better. I like to see price close above the moving averages without touching it, and then I execute on the follow through candle, which would have been here. So guess what? We entered right here, y'all, right here, right? I'm going to make this as realistic as possible. That would have been our entry right there. Bam, right? Where was my stop loss? My stop loss would have been the previous candle. I teach a 1 bar rule method. That means we're only risking 1 bar to keep our risk very minimum and have a big potential opportunity to gain more, right? It's about risk to reward ratio, right? So we risk 1 bar, and guess what? When it pulled back, it never hit our stop loss, right? And so guess what? From here to here, we were only risking 7 pips, okay? Not even 7 pips even, right? A seventh of a pip, right? For a potential, look how far this thing went up. Look how far it went up. All the way up here. And it's still going up, right? Literally still going up. So I'm going to show you where we entered at and where we would have exited at. Right? Right here on this candle right here. I utilize the biggest time frame. So if you are a day trader, your biggest time frame will be the H1. If you are a swing trader, your biggest time frame will be the H4. And if you are a positional trader, your biggest time frames are the daily, the weekly, or the monthly, depending on what you're looking at, right? So from here to where this candle closed, 43 pips. With a standard lot size, that's $430, right? Trading $10, that's a standard, $430. Easy, y'all. This is what we do. Hey, my name is Stiletto Pips. I want you to begin to like, follow, and then head over to YouTube and subscribe to the YouTube channel so you can get more tips on how you can become a profitable trader and make some pep moves with your girl. Talk to you later.